Hello, and welcome to the Business Insurance webinar brought to you today by Sica Fletcher. I'm Mindy Zisman, and I'm thrilled to be here moderating the webinar. Our topic today is 2026 Insurance Broker M&A Update, navigating the opportunities and challenges, and there are many this year. We're delighted to have the Sica Fletcher team with us today, and I'm going to hand it over to Pete to get us started. Pete.
Thanks, Mindy, and thanks everyone for joining us today for our annual insurance broker M&A update. With us today, we have Sean Napoli, Managing Director, Mike Fletcher, Managing Partner, and myself, Pete Herman, also Managing Director. Let's start with a brief introduction on Sica Fletcher. In the past decade, we've closed over $20 billion in deals, representing close to 400 sell-side transactions. We've been ranked number one in the industry for 9 of the last 10 years. We're the first boutique advisory firm to advise on billion-dollar-plus transactions. In 2025, we completed 37 sell-side transactions with more than $2 billion of transaction value, with individual deals ranging from $5 million to over $1 billion. In each of our sell-side transactions, we received approximately 8 to 10 bids, generating nearly 400 LOIs and offers from institutional investors and PE-backed buyers. This provides us with a huge amount of proprietary data and market insights, which we're excited to talk to you about today. Now let's dive further into what the data shows. 2025 was a year of normalization following the historic transaction volume highs from the previous few years, with some important structural shifts worth noting. Starting in the upper left, the total number of insurance brokerage M&A transactions in 2025 was just over 700, which is down from the 2021 peak of over 1,200, representing an approximately 12% average annual decline from the recent peak. Similarly, members of the Sica Fletcher Index, which is comprised of 22 of the most acquisitive buyers in the space, accounted for 466 of those transactions in 2025, also down from the 2021 high of just over 800 deals, a 13% average annual decline. In the bottom left, revenue acquired by SF Index members also declined from $3.6 billion in 2021 to $1.1 billion in 2025, a nearly 26% average annual decline, reflecting not just fewer deals overall, but also smaller deal sizes in average. In terms of buyer type, private equity-backed buyers continued to dominate the acquisition space in 2025, accounting for approximately 80% of total deals. Public brokers represented the next largest portion, with approximately 10% of total deals. Despite the overall decline from peak activity, deal volume remains well above pre-2020 levels, and we'll explain some of the key macro factors that have led to the consistently competitive M&A market in the space. This chart shows the variation in rank among the Sica Fletcher Index members based purely on deal count. The real point of this slide is to just show that the buyers rotate in terms of both deal appetite and overall acquisition volume. For example, Acrisure had historically been the most acquisitive firm for nearly a decade, with many years completing more than 100 transactions. However, as you can see here, in the last few years, they've scaled back and done fewer than 40 transactions in both 24 and 25. Now let's discuss the multiple of what. One of the most misunderstood topics in insurance brokerage M&A is how valuations are actually calculated and communicated. The big question, when a buyer quotes an 11 times multiple, 11 times what exactly? Two concepts really underpin all brokerage valuations. The first is EBITDA multiple versus multiple of what. The multiple alone is meaningless without understanding what EBITDA figure it's applied to, whether that's the actual EBITDA, a seller pro forma, or a buyer adjusted pro forma. The second is that the EBITDA multiple actually equals the inverse of expected returns. And Mike will dive into this aspect deeper in a few slides. Understanding both principles is critical for sellers when evaluating competing offers and maximizing their transaction outcome. So as an example of this, let's start with an example offer that a seller may receive. In this first section on the left, the seller is communicating with only one buyer, and that buyer has prepared the pro forma analysis. The result is an EBITDA of $1.25 million at a 25% margin, with an offered EBITDA multiple of 11.5 times. This would lead to an overall purchase price guaranteed at closing of $14.4 million. Now, it's worth noting that about a third of our clients that we work with do come to us with an offer in hand. And this is a very typical example of what we might see. Now let's look at how our analysis of the pro forma can help maximize seller EBITDA. In this example specifically, our version of the pro forma shows higher revenue, as this includes a run rate adjustment for new benefits accounts that have not yet been with the agency for a full year. We also eliminated the corporate charge from the buyer prepared pro forma, which was approximately 8% of revenue. In this scenario, EBITDA is increased to nearly $2 million or 38% margin. And as part of our analysis with our clients, we do a deep dive into every aspect of the income statement to maximize that EBITDA number. With the same multiple from the first example, this results in a purchase price of $22.9 million, an increase of nearly 60% versus the buyer prepared analysis. Now let's add an additional element to the mix by going through a competitive process. By engaging with multiple interested buyers as opposed to just one buyer, and by creating that competition, the deal multiple increased from 11.5 times to 12.75 times, with purchase price increasing another $2.5 million for a total increase of over 77% from the initial buyer analysis and offer. Now, this just highlights how sellers can turn the tables and level the playing field when navigating through the sale process. I'll now turn it over to Mike to discuss two recent mega deals in the space and how the multiple of what is key even in very large transactions.
Thanks, Pete. So Pete just gave an example showing why the multiple of what is often more important than the headline multiple itself. And so here's a real world illustration using public info. So in 24, Arthur Gallagher acquired Assured Partners for a little over $13 billion. And what's interesting is public filings show that there's effectively multiple versions of EBITDA for this deal. So pinning down a single purchase price multiple is difficult, if not impossible. So if you asked Jim Henderson, chairman of Assured Partners, hey, what did you sell Assured Partners for? He might say we sold it for 15 times EBITDA. At the same time, if you ask Pat Gallagher what they paid for it, he might say, look, we paid 12.2 times. And the reality is both of them would be correct. They simply used different EBITDA versions. Same thing happened with Brown & Brown in the Risk Strategies deal or Ascension deal. Depending on which EBITDA figure you use, the implied multiple range for this deal is from as low as 12 times to as high as 20 times. So in practice, both the headline multiple and really the multiple of what with these deals, they're really heavily negotiated. So each side's bringing teams of bankers and lawyers to argue over which numbers apply. And these are on these multi-billion-dollar transactions. So if you're a company owner selling today and the purchase price that you're effectively agreed to was based on the buyer's adjusted EBITDA, you're probably selling at a substantial discount regardless of the headline multiple. So these are live examples of why the multiple of what is so critical. And I'll hand that back to Pete.
Thanks, Mike. Now we'll dive deeper into the actual valuations from 2025. However, before we dive into the multiples, I think it's important to understand the full economic package of a deal, not just the headline number. So the first item to discuss is really that guaranteed purchase price. This is the true purchase price at closing, not including any contingencies, performance hurdles, clawbacks, holdbacks, anything like that. When we talk about multiples on the next few slides, this is the term that we're referring to, right? Now, there are some other key areas of a transaction that we don't consider, or at least don't include in that headline multiple, but are certainly important to the overall transaction. The first is the earnout structure. This refers to the opportunity for a seller to earn additional purchase price, which is tied to achieving certain post-closing performance metrics, usually based on revenue or EBITDA. Next is stock appreciation. Most private equity-backed deals will pay a portion of the purchase price in equity or rollover shares. And this offers sellers additional upside beyond the initial purchase price if the buyer's platform appreciates in value. The compensation structure is also key. Post-close pay arrangements for principals, producers, account managers are generally the largest expense in a brokerage, and any sort of misalignment here can materially impact the overall realized value and kind of the go-forward value in a transaction. Last on this list here is working capital. Think of this like the normalized current assets minus the current liabilities needed to run a business or the business post-closing. Adjustments are made if actual working capital is different than an agreed upon target, which will be laid out in the letter of intent. With that in mind, let's look at guaranteed purchase price multiples in 2025. Average EBITDA multiples on deals above $1 million of EBITDA have grown by approximately 20% since 2020, rising from 9.5 times to nearly 11.5 times in 2025. Now, we did see a peak in 2024 at 11.8 times, and we've seen it slightly come down to, again, 11.4 times in 2025. But the trend line in general remains well above 2020 and 2021 levels. Now, on this slide, we overlaid multiples for platform agencies to the chart, which we define as agencies with over $4 million of EBITDA. In general, platform multiples have consistently been approximately 1.5 times higher than the average multiples for agencies over $1 million of EBITDA. However, you can see that they've closely tracked the overall market trajectory. In general, these multiples have ranged between 9 and 14 times. And seeing these platform multiples in this range and being above kind of the overall average illustrates that larger agencies generally command larger valuations, right, and a higher EBITDA multiple. Also, as you can see in this chart, similarly to kind of the overall average, platform transaction multiples have stabilized in around the mid-13s over the past 3 years. What's really interesting is that despite the interest rate increases in the last few years, valuations for agencies over $1 million of EBITDA, including platform agencies, have been remarkably stable. I'll turn it back over to Mike to discuss EBITDA multiples and how they correspond to expected investor returns.
Great. Thanks, Pete. So earlier, Pete hammered home the importance of, how the multiple of what is more important than the multiple itself. But I think it's important to ask, what is an actual multiple? What's the purpose behind the multiple? So people throw around multiples all the time, but technically, a multiple is really the inverse of the return the investor is expecting. So for example, if we take a 10 times multiple and we invert that, the math is, 1 over 10, that's a 10% return. So if you're an investor and you're buying, EBITDA or income for a multifamily apartment or earnings from the S&P and you're paying 10 times that, you're sort of expecting a rough 10% return. And so if we take, for example, a 20 times multiple, 1 over 20, that implies a 5% return. So on this chart here, we're showing the same average historical EBITDA multiples that Pete showed, but we also add in the inverse of the multiple right under that, or the expected return. And so this gives you a sense of, the returns investors are getting roughly when they pay that particular multiple. So for example, on the left of the chart, in 2021, we have a 10.1 multiple, and that implies an expected return of about 9.9%. And what you'll see as multiples rise, the actual expected return falls, which sort of makes sense given it's the inverse. And what was surprising is, the increase in multiples and decline in returns from 22 to 24. And as Pete just mentioned, that's surprising because that period also saw the largest interest rate hike in recent history. So with this slide in mind, this brings us to our next slide. And frankly, we're hesitant to show this slide because it gets probably too much into the weeds of insurance broker, deal economics. But we decided to show it because it tells an important story. So again, let's start off the left again. And if we look at 2021, same multiple, 10.1 times, shows an implied return of that 9.9%. But this time, what we're showing below are at that time, the average borrowing costs for these brokers, which is around at that time of 4.5%. So that produced a spread in the middle of about 5.4%, which is obviously a recipe for strong returns. So in short, if you're buying any asset that yields a 10% return and the funds to finance that investment are 4.5% cost, that leads to pretty impressive returns. Now, positive returns like that attract competition, which pushes multiples higher. And you could see that, moving along the line here as we move from 21 to 22. But then if you look at the line below, interest rates spiked to about 5% by the end of 22. So suddenly that spread, which is in the green that we're showing here, which is really, money printing in my view, now buyers are acquiring brokers for implied returns they're going to get, for example, in 23, 24, they're getting implied returns of 8.7%. But to fund those acquisitions, they're borrowing at 9.5%. And that's what we call in red the negative spread. So, that's poor economics, and that would normally force multiples down. But multiples have remained remarkably resilient throughout that time. And, I'm going to turn to Sean to explain why that's the case.
Thanks, Mike. So despite the largest interest rate increase in history, valuations have held relatively steady. So we believe the stability is supported by three key factors: robust premium growth, multiple arbitrage, and elevated buyer demand. So as we talk about premium growth, why did interest rates go up? Interest rates rose due to inflation, but inflation also caused premium growth. Inflation hurt the broader economy, but for insurance brokers, it boosted premiums, which boosted revenue. So if you look at this chart, it resulted in a compound annual growth rate of 9.5% from years 21 to 24. Multiple arbitrage also played a big role. Buyers of scale are generally valued at a higher multiple of EBITDA than the agencies they acquire. So very, very simply put, if you buy an insurance broker at a 10x multiple, you continue to scale, and when you have enough of them together, you sell for a 15x. That's a 50% increase in enterprise value. And that right there is multiple arbitrage. And last but not least, buyer demand. If you were selling your agency in 2007, there were 5 buyers in the marketplace you wanted to get to know. As we fast forward to 2025, we now have 50 institutional buyers in the marketplace. That's a 10x increase in the competitive buyer landscape. These three factors are what we feel have kept valuation stable. But beneath that stability, an elephant in the room has emerged. And Mike will now unpack that for us.
Yeah, thanks, Sean. So, Sean just pointed out remarkably stable valuations despite the interest rate increase, which frankly surprised me for a while. I mean, I was the one in 22 probably calling for a decline in rates, decline in multiples. It didn't happen. But that's not to say that cracks didn't begin to appear. And so, in 24, the effects of higher interest rates finally began to show. And this first started to show in the billion-dollar-plus insurance broker market. And we're going to go back to those 2 deals we showed earlier. So, for example, at the end of 24, we mentioned Gallagher acquired Assured, and they acquired Assured for an effective multiple between 12 and 14 times. The short had 1 billion of EBITDA. That surprised the market for two reasons. First, most assumed a short would trade to another PE sponsor. Historically, a short and its peers rotated among PE firms every few years. And second, the multiple surprised observers, right? So the prevailing expectation was probably that an asset like this would trade for 17 to 20 times EBITDA for a large PE-backed broker. And recent capital raises, even that a lot of PE brokers, they were priced in that 17 to 20 valuation range. So the headline multiple here, 12 to 14, really stunned the market. But for us, we put out a few pieces on this. We thought the deal and the lower multiple made a lot of sense. And really, here's why. For a private equity firm, 17 times is not feasible at this scale. The math just doesn't work. So PE firms pitching, they pitch high teen returns or net returns to their investors after fees. And they're commonly, the common fee structure for PE firms is 2 and 20. That's 2% management fee and 20% performance fee. So to deliver those types of high teen returns, private equity firms need 20 to 30% gross margins before fees. And over the past decade, PE firms have achieved those returns primarily through, number one, multiple arbitrage, which Sean gave you an overview of, buy at a low multiple, sell at a higher one, and two, financial leverage, i.e. cheap debt. So that formula made insurance brokerage a PE favorite for quite a long time. Now, in this case, if a PE firm actually paid 17 times for a short, the expected returns from that multiple expansion, organic growth would be limited. So let's just go here. Simple back of the envelope, 17 times multiple implies about a 5.8% return or a 5.8% yield on that EBITDA. And then if we add in Assured's potential organic growth, the 3 to 6%, paying 17x gets you about 8 to 12% returns before leverage. But with borrowing costs at 7 to 10%, it's going to be nearly impossible to generate 20 to 30% gross returns by levering the deal. So that means that if you're going to buy Assured, you're going to rely on acquisition growth to fuel returns, but Assured already had $1 billion EBITDA. So adding a few $10 million deals here or there wasn't really going to move the needle. And so, given those economics, Arthur Gallagher stepped in. And we put a piece out there that we conclude, we think Gallagher executed one of the best deals of the past decade, given what they were able to buy Assured for and how much EBITDA they were able to acquire, i.e. $1 billion. But we also thought that Assured shareholders got something, a really good deal as well, because they got full liquidity. So in our view, this was a solid outcome for both of them. And then this trend continued in 25 when Brown & Brown acquired Risk Strategies. Again, Risk Strategies expected to sell to another PE firm. In our Leaders and Legends podcast, Mike Christian, founder of Risk Strategies, said he never imagined Risk Strategy would sell to Brown, but the same market pressure pushed that outcome as well. And at the same time, we also viewed that transaction as really good, for both sides. So, these transactions were what I call the early cracks. But the larger issue to me, at least, surfaced by the year end of 25. And that, is public valuations, in particular, Brown & Brown. So, we highlight, here. So basically, here is stock performance of Brown & Brown in 25 versus the S&P. And you could see Brown & Brown started the year, jumping 20% in value and then declining, 40%. And so, what happened to Brown & Brown there? Now, is this a case of, are we just picking on Brown & Brown? No, this chart shows, a public broker composite, and all brokers suffered. But, we highlight Brown & Brown because it's really represents, the middle market insurance brokerage sector. And in our view, acts as a bellwether. Now, most people don't realize Brown & Brown's been one of the best performing stocks over the past 25 years across all sectors, not just insurance. So, what happened to Brown here? Did higher interest rates finally catch up to Brown? Well, the answer appears to be no, because Brown & Brown has low use of leverage. In fact, Brown has one of the best, probably strongest balance sheets in the entire industry. And unlike many PE-backed buyers, does not rely on leverage to generate return. So example, on the left side here, you could see Brown & Brown's equity value at that time compared to the debt that they had in their capital structure versus your typical PE type investments that are heavily exposed to interest rate leverage. So if it's not interest rates, what happened? And the issue to us, as this chart would show, it really seems to be slowing organic growth. So Brown's organic growth fell from about 8% in 24 to 3% by the third quarter of 25. And that mirrors the decline in commercial premiums that really affected the entire industry. It's affecting the industry today. So our view is that Brown's decline is clearly was a result of the market being maybe a little spooked by maybe what's coming as a soft market in the insurance world. So with that sort of undermines one of the legs Sean was saying. Instead of robust premium growth, now we have stagnating premium growth in the market. So the next two legs would be, okay, well, what about multiple arbitrage? This is probably the most interesting chart of this whole deck. Look where Brown & Brown was trading. So in I guess the start of 2025, Brown & Brown traded roughly 19 times EBITDA, but by year end that premium had largely evaporated. So if one of the best managed, least levered companies is trading at 12.9 times EBITDA, how can a PE-backed broker expect to hit maybe 16 to 20 in a sale or IPO? Now, to be fair, Brown & Brown is probably overshot to the downside. Now, while we don't own any public broker stocks, for a bullish investor who doesn't expect AI to displace Brown & Brown or the brokerage market in general, current levels may present a interesting buying opportunity. So, which brings me to the next part. So, really, the only thing we have left is elevated demand, and that's what's frankly supporting valuations today. Sean showed this slide earlier. Like you mentioned, back in 2001, when I started doing this, there were a handful of buyers, and actually including some banks that we don't even have listed here. And today there's 50 plus, and that depth basically makes it very difficult for buyer groups to push valuations sharply lower in the $1 to $10 million range. And I would point out there's also built-in support from PE buyers in terms of structure. So, for example, in 2013, there's about $300 billion of PE capital chasing deals. Today, that number is closer to $2 trillion. So with a 2% management fee, that equates to roughly $40 billion in annual fees that PE is charging their investor base. Now, to put that in perspective, the total P&C commissions in the United States are roughly $80 billion. So the fee alone is 50% of the entire insurance broker commission base. So given the fee-driven economics, we think PE managers are unlikely to return capital to investors simply because valuations are high. Instead, we think they're going to continue to deploy capital and offer accepting mid-teen to low double-digit multiples for smaller brokers, and hopefully wait out interest rates coming down and the IPO market picking up. Now, some will ask, why doesn't a PE firm just buy Brown & Brown instead? You can buy Brown & Brown at 12 times. Probably a sensible investment, but PE managers can't reasonably charge 2 and 20 and then simply buy a public equity that investors can purchase themselves. So in short, for the $1 to $10 million EBITDA market, we think that strong buyer demand, i.e. the dry powder plus fee economics, will continue to support valuations even as premium growth and multiple expansion weaken. So where do we go from here? Well, in addition to the structural support I just mentioned from the private equity firms, we believe there's some additional green shoots that have started to develop beyond the roughly $2 trillion of PE dry powder. And so, for example, Number one, the decline in premium growth is really concentrated in larger accounts and E&S lines where mid-market brokers really have less exposure. Number two, ironically, as organic premium growth slows, acquirers now are relying on acquisitions to meet those growth targets, which applies upward pressure to valuations. And number three, despite this recent oil price pressure, which would normally push interest rates higher, we expect the Fed will probably ease later this year, which would raise those expected returns that we talked about and support valuations. And finally, if AI does not fundamentally disrupt the brokerage model, these sectors, what we consider enduring attributes, recurring cash flow, high margins, regulatory demand for coverage, low capex, we think that's going to continue to attract institutional investors throughout 26, and in particular in that what we call mid-market, the $1 to $10 million EBITDA business. So that's where we think the market's going.